So let's assume that the business owner says, that sounds like a good place for me to put some money. I've got some money I want to invest and earn better than bank interest rates or so. So what are some of the vehicles, how they can actually be the bank by investing in loans?
We all want to be the bank someday. And you've got to look at risk. Some people see alternative, we can call this alternative type of investing, as risky. But the funny thing is, the bank will take your deposits and they will invest in the very things that you could invest in. And they're doing the same thing. They're doing everything they can to mitigate risk, but they're taking the risk. So there's, different ways that you can retire. You can put your money in the bank and earn whatever the interest rate is at the time, and the government certainly has manipulated that during the last 10 plus years. Or you can be the bank and invest in investments that will give you a good return. The first one I always recommend is mortgages, and that's because it's secured income. You're getting a higher than normal income, and right now 7 to 10% range income from first trustees that, as I mentioned, there's different asset types, but a loan to value on a single family home we would typically cap at 69%. Apartments, maybe 65%, duplex, triplex, fourplex, small apartments, 20 units or whatever. 65% standard. We'd usually want loan to cost to be more like 80% loan to cost. We don't go to the 90 usually on those. Lots and land. Land is like 50% acreage. I'm talking raw acreage. Somebody wants to borrow money on 20 acres, and we're not really even big on that right now because of the bad taste in our mouth from holding certain pieces of raw land from the past. So improved lots are a little different story if it's in a very buildable area, marketable area. We do 65%, and we will go 80% of cost on improved lots. So different types of assets, you do want to break them up. You don't want everything. And even if you decide, I'm going to put everything in single-family homes, I would say that's not an unreasonable thing. Single-family homes are the most marketable real estate on the planet. But you wouldn't want it all on one borrower, now would you? So that's another way. And banks do the same thing. Banks can only lend a certain percentage of their capital to a single borrower. And we're going to do the same thing in our own personal bank to mitigate our risks. So
those are some excellent examples. Now, as far as investing in mortgages, there's a couple ways they can do it, maybe through a fund that has some diversification, or owning mortgages directly. So you want to...
Well, let's discuss those. And there's different ways you can hold title in those. As an example, you can hold title in an IRA, in a 401k, family limited partnership, family LLC. Those are very common. People would typically set those up with their estate planning. We're going to all die sometime. The goal on those is usually to gift the ownership in those entities off to your children, before you pass away. So, but that's a wonder, and retain control over those entities until you're gone. So. They're not going to get anything till you're gone. You're going to manage it. That's the reason you would set those. Another one here was corporations. Some people own these in corporations, and interest income is considered portfolio income. And so it's just like your wages. You're going to pay taxes on this income. So in a C corporation, you can write off certain business expenses, including a medical reimbursement plan, that you can't write off in other types of entities like a LLC or a partnership. So that's why people would do that. So you can hold title in your bank. You can have several banks, right? You got a 401k. You can invest in your 401k. You got the family limited part. We have investors with several entities that they're buying mortgages for. So that's just how they can have their bank structured. So a lot of investors like to invest in direct mortgages. You buy the whole loan, you make all the decisions. When we set those up to be serviced through an independent account servicing agent. We set it up so it's almost like buying a piece of real estate. You're going to go through an escrow. You're going to get title insurance on the loan, title insurance into first lien position. If it's a loan that we've already funded, you're going to get a number 1 endorsement in Arizona, because each state, they call them something else, that transfers that title insurance policy over to you. The insurance is going to be there in case there's a fire. You're going to be protected from that. You own it lock, stock, and barrel. You make every decision. If the borrower is late, he has a good excuse. You want to waive the late fee, it's your choice. If you don't want to waive it, it's your choice. You make every decision. And it's a good investment. Many of our clients do that. Another way to invest in deeds of trust is to go in a fund. We have 2 types of funds, but the main fund is where we set up a LLC. You come in as a member to be a trustee or a mortgage investor as a member in the fund. As I mentioned back during when we was talking about broker-dealers and syndication, private placements, there's a preferred return. We call it a priority return in our fund, and that's a 7% priority return. So you're going to get 7% before we get anything other than a small management fee. And then our target return is 9 to 10%, which is what you would probably get if you was buying an individual deed of trust, somewhere between the 9 to 10%. While the preferred return you're going to get before we get anything, the other 9 to 10% target, as we get there, then we'll make more. Mm-hmm. So the more you make, the more we're going to make. So that's good. But the benefit of investing in a fund, comparing it to an individual deed of trust, it has a low entry amount of $25,000. When you buy a deed of trust, let's say it's a $300,000 first deed of trust, you have to have $300,000 at that time liquid to buy that deed of trust.
And you're putting in one investment.
So in a fund, typically in a fund, as the fund gets bigger and bigger, you're going to have 30 to 50 deeds of trust in that fund. That's the goal. And so you're spreading the risk and risk of foreclosure, risk of loss, but you're also spreading the risk of income interruption. Because if 1 or 2 loans go into a foreclosure process, or just the borrower's late on his payments, he's not even in foreclosure yet, he's late on his payments. If you have a $300,000 note and he's late on his payment, you didn't get your interest on that $300,000. But if 1 or 2 of those loans did that in the fund, it's going to have a very minimal impact on your cash flow. The fund is quarterly. That's different. So the fund is for 5 years. It's a 5-year fund. There's a little less than 5 years on the one that we have now. Is called Private Bankers Mortgage Fund 1. So if you're interested in that, you do have to be an accredited investor on that particular fund. We do other funds that you don't have to be an accredited investor on from time to time. And they also are referred to as a pool, a mortgage pool. We're calling it a mortgage fund because we're going to invest in multiple loans in that fund. Another one, sometimes we'll have a larger loan, maybe $1 million, $2 million, and a lot of times our investors don't want to let their funds accumulate to $1 million, $2 million in a bank. You're losing income by doing that, by not having it invested in mortgages. So sometimes we'll set up a syndication for that single mortgage or deed of trust.